if we see a slowdown in the US market and the Chinese data start to slow down, well, we're basically the punching bag in the middle.
Mathan, welcome back to Dukascopy TV. A pleasure to receive you as always.
Nice to be back again.
No problem at all. Now let's take a look at some of the local share market action we've been seeing of late. Now, how would you characterize some of the May market madness, as it were?
I suppose the usual cycle is being played out. We've had a good run in commodities to start the year. That's actually gone a lot longer than most people expected. So that's beginning to come off now. You've seen the Chinese stimulus have a pretty good effect, and you've seen a substantial decline in the US dollar, which has helped that last this long. So we're seeing that coming off. The bank sector, which is the dominant sector for us, has been hit with just about everything. And at this point, it's doing quite well. But it is just at the start of the ex-div period. We've already had ANZ go through. We've got two of the other big four going ex-div in the next week. Generally, you will see a bit of weakness after that. So we'll have to wait and see. But I think the market is probably going to have a bit of a pullback. And that's usual cycle. But look, the fundamentals are looking good given the macro environment. The macro environment is still slowing down. But given that, the equity market is actually doing okay.
You touched there on the banking space. What are the other sectors of interest for you at the moment?
I think the key one is obviously service-related industries. They're doing better, and the currency-related one. So the businesses that have a global business models are doing well. So the obvious one for both of those are someone like healthcare. You're looking at CSL, Ramsey. They're all trading pretty close to their all-time highs. I think CSL is at all-time highs. And I think they'll probably continue to do well. Then the other sectors like service-oriented, the educational side of things are doing well. You've got the tourism sector doing well. So there's a number of stocks in the tourism sector that has actually had a decent pullback in the recent times. And they look quite interesting. And I think the currency likely to go below 70 cents and not too far, but it'll be slightly below 70 cents. And that should give another kicker for those stocks. So I think tourism stocks will do well. And I think a lot of the IT stocks, which have global business models, we've got a lot of good quality IT stocks like the LTMs, the Hansens, the GBTs, the intermediates. They're all looking like they're going to have another big run. And as the currency comes back, all their valuations will improve. So I think they'll do well as well.
We have, and this isn't a trend just limited to the domestic market here in Australia, but globally we do have that sell in May, go away. Are we seeing much of that come into fruition in the domestic market at present?
I think so. I mean, we do tend to be the poor cousin of the US market. We tend to follow them. And the US markets looks quite expensive where it is. And the earnings haven't been shooting the lights out. So there is always a pretty high risk that the US market will see a bit of profit taking in May. The volatility index, the VIX index in the US is pretty low. So there is always that. That's one side of the argument. The other side of the argument, we've actually had 4 or 5 months of pretty good Chinese data that's held up commodities longer than we expected. So that's coming off as well. So for us, if we see a slowdown in the US market and the Chinese data start to slow down, well, we're basically the punching bag in the middle. So we will go down as well. So I think for us, the local data has been, I suppose the inflation took a fair hit on us. And so we already had a rate cut and we see more rate cuts coming. So we are seeing weaker economic data coming domestically. And then the two main, I suppose, trading partners are also going into a weaker cycle. So the risk is quite high.
So with that in mind, then, what are some of the sectors or even some of the stocks that you're choosing to stay away from?
I think, look, resources. I think most commodities will be under pressure because you've seen US dollar starting to bounce back after probably about a month of weakness. I think all the base metals, the iron ores, even the energy space, which had a really good run on the Doha optimism, which didn't pan out. And then you've had the Canadian wildfire potentially holding it up, and now that's coming off as well. So there isn't a lot of supply changes in most of these commodities to support the substantial bounce that they've had. So most of the commodities will come back and the share prices will come back with that. So I think that most commodities will struggle. I think the commodity I still continue to like is gold. The precious metals, I think gold, silver will do well because I think the market risk is quite high. Central bank actions have to be unwound at some point, and nobody really knows how that'll play out. So those kind of market risks and deflation worries around the world is actually helping precious metals. So I think gold and silver will continue to do well. Any kind of pullback like we're having today should be a pretty good opportunity to buy it.
Mathan, thank you so much for the insight.
Not a problem.
Our many thanks, as always, to Mathan for his comments today. Do stay tuned as I'll be bringing you plenty more exclusive interviews, including a look at what comes next for both the Reserve Bank of Australia and indeed the federal government with Shane Oliver of AMP. For now, though, it is goodbye.